Welcome to Privacy Now, your go-to podcast for privacy, crypto, and AI. Each episode, we dive into the latest advancements, explore cutting-edge innovations, and bring you insights from experts shaping the future of Web3 and AI. From crypto degenerates to the ones in it for the tech, Privacy Now has got you covered.
Hello everyone. Today we record in person. So welcome back to Between Two Palm Trees. No, I'm joking. Welcome back to Privacy Now. I think we only did the first episode in person. The rest were online. So since we're at them, we decided to set up a nice corner where we can record. So I have two amazing guests. Robert, he's my colleague.
Hello.
But my other guest is somebody who's going to pretty much revolutionize the market. So we have with us today Rico van der Veen. Did I pronounce it correctly? Okay. And they're actually doing. So he's the CEO and co-founder of SemiLiquid. But they're actually doing something they're calling a concept called collateralized liquidity instruments, or CLIs. And this is a system for unlocking value from unvested tokens. Before we get into all the details, all the nitty-gritty, Rico, I would love if you could tell us a bit about yourself, like maybe how you got started into Web3, what's your background and everything. So, please.
Yeah, thanks for having me. It actually started with finding out about Bitcoin, right? So I invested in Bitcoin as early as 2014, which I made some money off of. And then the first investment that I did was in the initial coin offering of Ant shares. That's now called NEO, right? So we made something out of that. And from there on out, I wanted to do different things, right? And I think that the most important part about crypto and blockchain in general is to make the middleman go away, right? To cut out the middleman essentially. And I think that what we are doing here is making all the legal legal enforceability, all the lawyers go away as well, right? So it's right up where I started.
Okay, nice. That sounds lovely. And you might be wondering why we have Robert with us today. Robert is directly involved in Rico's project, so he's supporting the project, and he knows way more about this than I do. I honestly understand like 0.5% what these guys are doing, but it sounds amazing, and it sounds like it's really going to revolutionize the market. So, Rico, Robert is going to get into the more technical details, but I want to know the basics, like what got you, did the idea come to start SemiLiquid?
So essentially the idea came about like 3 or 4 years ago already, right? I saw that all of this huge pile of value was locked, I couldn't do anything with it, and to get real value out of it was very tiresome, very cumbersome to do so. So I wanted to already back then start something to unlock that, right? But the technology wasn't there yet. Or you had liquidity fragmentation, or you had public visibility, right, on a blockchain. So the technology was not there. But now, it was December or something, or November, and Cornell Tech came out with the research paper about liquefaction, and then it immediately clicked, right? I thought, okay, this is how I can accomplish what I already thought about, right? From there on out, we started to build, and we had like a demo in 4 weeks, 5 weeks. So, yeah.
I actually had James Ojan from Liquefaction invited on the podcast. We did an episode with William, and I was wondering even back then, like what would be some cool use cases for the and what could be unlocked using this. And apparently, you guys pretty much cracked a really good one. Robert, what do you think about everything that's happening with SemiLiquid?
Yeah, it honestly kind of happened so quickly. Like, they saw the research paper pretty much when I did, right when it came out. And at the time, I think I made a Twitter thread about it or something like that. I was like, oh man, this is so cool. Like, look at all the different use cases. And I don't know if I fully understood like how quickly things can move. But basically, Rico from SemiLiquid just reached out and we made the magic happen. We've, of course, been happy to work with them. They've been great. very quickly. And yeah, I think in the next little bit, we're going to have some exciting news. So yeah, that's all I'll say.
I'm not gonna pry. It's your thing. I'm just here for the podcast. But for our audience that doesn't understand all these concepts, first of all, what is token investing for people who are not familiar with the term? How is it used in the market?
Yeah, so token vesting is used because you don't want to have all your tokens on the public markets right away, right? If the project is not ready yet, you don't want to have all the people who have got into a discount at a discounted price sell on the market, right? So what they do, they lock it away, and you can get batches of these tokens at different intervals. Let's say vested over 3-4 years, right? So you get each year a little bit more of the tokens, and you give the project time to grow and build, right, before getting all of the tokens being sold. Yeah, so that's initially vesting. One bad thing about vesting is that you're locking away all of this capital, right? Okay. And not only for investors, but also for foundations themselves. Foundations, they also lock up the treasury, for example, to communicate that, hey, we are in this for the long run. But in that process, they're also limiting their own capital efficiency, right? Because they lock that value away. So that's in a nutshell what vesting is and why it's being used.
So, who would you say suffers more from this liquidity being locked up, like the actual project, the team, or the investors?
I think the capital inefficiency of locking away this amount of value is bad for the whole market, right? In general. But if you look at who is most eager to unlock that capital, then those are definitely VCs. They have an obligation to make as much money as possible for their LPs. Okay. So that's what we are seeing, right? VCs are really eager to unlock this capital, with foundations being a little bit more defensive.
Yeah. I get that. So, why do you think nobody addressed this issue? Like, wasn't it possible tech-wise? Was it a limitation so far?
Yeah. So, specifically, it was tech, right? So there are also some startups that have tried to unlock this, right? But what they are doing is kind of like a middleman, right? So they are kind of like the broker dealer that basically says, okay, what do you want to sell? I will find you a buyer, right? So very high level and manual. So the other technological innovations, again, have the limitation of liquidity fragmentation or privacy, right? And now you have, with Liquefaction, you can have on-chain privacy, you can have an off-chain order book with no counterparty risk, because Liquefaction takes care of the settlement at unlock date, right? So in short, the tech is now ready, and it wasn't yet.
Good. Yeah, you keep the mic. Okay. Sorry, I keep forgetting I'm wearing a mic. Yeah, so I guess just following up on that, we say that it's important to have this liquidity and capital efficiency. What's maybe like a specific case where this might be important?
Yeah, I think that. So, for example, if a foundation, right? So, a foundation currently needs to issue more tokens, for example, or do another fundraise, right? But they are sitting on top of locked value, right? So, in a better scenario, they could use that locked value as collateral for a loan, for example, right? So they don't need to sell more tokens to another investor. So that's one thing. And the other thing, like what I touched on before, is that the VCs, they need more money to invest again, right? So maybe if they can now access the capital much more efficiently and seamless, they can invest into more projects. This would be kind of like a snowball or flywheel effect, where VCs take on more risk because they know they can be de-risking some of their investment early on, and that's in essence why it's better for the whole ecosystem.
No. Yeah, I think maybe you touched on this a little bit, but more specifically, like in terms of the risks associated with these alternate solutions, like something that's not semi-liquid, which we'll get into the details of, but what are the risks at play there?
Specifically, most of the risk involve counterparty risk, right? So, for example, non-delivery. So a legal forward contract, right? A forward contract is something between a market maker and the unvested token holder, essentially. What they do is they say, okay, I'm giving you cash now, so let's say 100 million, I'm giving you 50 million right now. You are going to deliver those tokens when they become unlocked to me in 2 years, right? What we see is that a lot of these tokens are never delivered because the tokens are times 10 or something, right? So the value has increased tenfold. So what they do instead is they give back the cash with a fine. So that's kind of like the counterparty risk, what the market maker takes on now, right? And that's why the market makers that we are talking to are all over this, right? Because they can still take the other side of this trade, but much more efficiently and without any counterparty risk, because Liquefaction makes sure that the tokens are delivered at that unlock date.
Yeah, so do you want to take the next one? Okay, yeah. So I guess, you're alluding to, that market makers, VCs are interested in this. Have you seen any pushback from foundations already regarding this, or?
So initially we wanted to include them, right? So we said, okay, this is better for everyone, and there are a lot of great things for a foundation to look at, right? So one thing is the loans on locked treasury, for example. But another thing is that for a foundation you could mitigate unlock volatility, right? Because you can create a secondary market 4 months before the unlock date. So there are a lot of great things for a foundation, and we try to get them involved as early on as possible. But then there was real defensibility, and they didn't really want to talk, right? Because they said, okay, no, this is how we do it, and that's it. Because they didn't really see the value add now. The market makers are a whole different story, because again, they can essentially make money 3 ways, right? Because on SemiLiquid we have an exchange, right? And they can market make on that exchange, right? So they can market make the 1 year out CLIs, for example. So they can earn the spread between that. They can have the buy side that they already do, but now efficiently. And they also have most of the time venture teams that have sell side they have unvested tokens ready to be sold. So they can earn money 3 ways using SemiLiquid, and that's what got our attention.
I do have one curiosity. I don't know if it's a stupid question, if it makes sense, but is there a need for an ecosystem to be created around this, for like the unvested tokens, for somebody to actually want those tokens to be offered to make sure that a loan can be?
It's not a stupid question. It's a great question. Yes, we need to have, and that's why we need to get all the stakeholders involved, and that's why we also need to incentivize all the stakeholders, right? So to your point is that we can only start with the lending part of it when you have a liquid or semi-liquid private market, right? Where the collateral, if you put up your CLIs as collateral, can be sold if LTV drops, right? So yes, we need to have market makers involved, we need to have sell side involved, and buy side. And that's essentially where we are working towards, right? To a soft launch with 50 sell side participants, 4 custodians, a couple market makers, and a list of natural buyers, essentially.
Right. Yeah, no, I think that makes perfect sense. Basically, how, like with liquidations, I hadn't actually really thought about that until recently. But yeah, if you want to have a lending protocol, a DEX is a primitive, right? And this is no different. This is essentially the same thing.
Right, and one example is that so we were talking with Galaxy, and Galaxy was financing these unvested tokens like 3 years ago, 4 years ago already, right? But then, to your point, is that they gave like 20% LTV on TIA, and TIA were locked, so they couldn't sell it when the LTV dropped, right? So now with SemiLiquid, you have the CLIs that represent the unvested tokens, and they can be sold if needed, right? So that.
Perfect. Is there any? I guess we focused on kind of some of the positives, who's interested, and maybe who's not interested. But is there any like regulatory scrutiny or issues here? Because this is like uncharted territory.
Yeah, right, and that's also a great question. So what we do now, we have basically filled in everything around being it not classified as a security, being it not classified as a derivative, and now we are working with legal to get it signed off on, right? So one of the main things is that a derivative is governed by legal paperwork, ISDA to be specific. we don't have that. We don't have any legal paperwork because the liquefaction and code is law, essentially, right? We make sure that it works like that. So a derivative is kind of like easy to debunk. And then a security as well, if you are not deriving value from the work of others because it's just a receipt, essentially, right? You have a receipt. If you have that at the unlock date, you can then come collect the unvested tokens, right? That's kind of like our narrative behind it, but we still need to get legal to sign off on it. But it does seem like we can go around those classifications.
I think based on current trends, I'm pretty confident that it should be fine. But yeah, no, I was impressed that all the paperwork you showed me, like you guys have been doing your due diligence from the get-go, so I have full confidence. In terms of the tech now, let's get into some of the nitty-gritty. We kind of talked about what SemiLiquid can do, but like how does this work, right? Why is Oasis here sitting and talking about it? So do you want to just get into like a little bit more of those details? Like what is SemiLiquid really? How do CLIs work?
Yes. I think from Oasis perspective, right, so why we chose to go with Oasis is fairly simple, is that you guys are the only ones who can support liquefaction at scale, right? So there are some other ones that have some kind of trust execution environment infra, but you guys are just superior in that sense. So how we understand, and I understand on a high level, right, because I am also not the CTO, but I can understand it from a high level. How I understand it is that you have the policy of the liquefaction address running on a smart contract inside of a trust execution environment, so you don't have any on-chain attack vectors, for example, and it's basically hardware enforced, right? So you're enforcing those rules. And our policy in that smart contract is when the on-chain address receives or will receive the tokens at the unlock date, then we can issue CLIs on a one-to-one basis, right? Because then we are absolutely certain that the CLIs can be swapped back, right? Because that's crucial for this work. Yeah, that's basically most of it. Do you want to touch on the custodian integration, or?
Yeah. Well, let's talk about the tech just a little bit more first. But let's see. I mean, I guess we talked about some of this already. Basically, I guess I could just start off, and if you want to add anything, in terms of like Oasis and the TEs, basically you're leveraging the fact that previously you had to assume that if someone held a private key that they were the owner, and that there was really no way to share your private key with somebody without risking everything on it, right? So, if I was staking some funds and I want to give partial ownership or something like that, you just can't do that. And then this is really, the whole point is that you're changing that now, right? If that makes sense. You're giving away where you could share parts of your private key and not the whole thing. But yeah, that's basically Oasis in a nutshell as far as liquefaction goes.
Yeah, right. And I think that's mostly liquefaction in general, right? So what James and the guys at Cornell have created. So what we do on top of that is essentially created an instrument called the CLI, and that is our policy, right? So instead of having private key level access, essentially you make it CLI level access, right? So it's analogous to your private key essentially. But the CLIs are tradable, and a private key isn't.
Right.
That's essentially it.
Right. Perfect. Yeah. Okay. So let's get into custodians a bit. If you want to just kind of start off, what's your relationship with custodians so far?
Yeah. So when we started out with liquefaction, liquefaction in the paper it's self-custodial, right? So you have an EVM address, a public-private key pair. And that's it, right? So the initial thought was, okay, we will go, as an investor, I will go to the foundation, I will give this EVM address because there is no visibility that is a liquefaction address, so I will just go there. This is my destination address, here is where I will want to receive the unvested tokens from you. The problem there was that most of the unvested tokens are already distributed, and they are residing at custodians and they can't be moved, right? So that was kind of like the initial hurdle that we needed to overcome. So I thought, okay, these investors, they sit on like paper gains of 50x or 100x, right? So we can get away with 2% fee or something, right? If you need to pay 2% fee to get enough liquidity to invest again, that's not a lot, right? So with 2% fee, you have kind of like a lot of spread also to distribute to other stakeholders to get everyone aligned, right? That's what we did with the custodians. We basically said, hey, if you are building this in, you're adding a button, create secondary or get a loan, powered by SemiLiquid. Then every time someone clicks on it and creates CLIs, then you will receive 0.5% fee. And that has seemed to be kind of triggering for a lot of them because they only charge 20 basis points on custody. So if they now charge 20% of 20 basis points on assets under custody, and then the locked assets under custody, they can earn 50 basis points on top of that, was quite compelling. So that's kind of like how we started with some custodians. We are trying to get 4 on board for the soft launch, and we just signed the MOU with Zodiac Custody, which has clients like Galaxy, Brevin Howard, and is owned by Standard Chartered and Northern Trust, right? So it's kind of like a big player, and it's also kind of surprised me that they wanted to act so quickly, right? Most of the times these big regulated entities, they move slowly, but maybe it's a signal that this is really something that has product market fit, right?
Yeah, I think the speed that I was referring to earlier is just like phenomenal, not just in terms of getting things built, but in terms of everybody else, all the different pieces that everyone wants to be on board, as far as I could tell, as quickly as possible. I think that was just kind of just impressive.
Yeah, I want to add to that because coincidentally, I'm in a Telegram group with you guys, and I've been keeping track on how things are moving. And I don't know, you said you want to launch next year, from what I remember. But I don't know, things are moving really, really, really fast. Like, you guys are doing a lot.
Yeah, right. And essentially the idea was to do this soft launch in Q2, right? Because what we need to do essentially integrate sell side and buy side and the order book, so those 3 technical capabilities, and then some licensing. But as we have been speaking to a lot of these VCs and stakeholders, since everyone is saying, why can't we do this tomorrow, right? So they really even want to improve that part of speed, right? So that's why we are raising a seed round, and we started out low, but it seems that everyone wants to get us up to speed as soon as possible. So it seems that we are actually expanding the round to hope to do the soft launch in December this year instead of Q2 next year.
I think one thing Web3 can learn from Web2 is you don't need to rush things. Rushing things is the last thing you want to do. Just look at traditional companies, look at software companies, look at gaming companies. Delays and delays because they want to get out an actual working product. You don't fix bugs as you go because that's irresponsible, especially when you talk about people's money and, right, the product needs to. So I think this is one of those products that whenever you guys launch, I think it will be incredible. And I have no doubt.
Yeah, so it's turned up. All right, where was I? So we talked about custodians a bit. So as far as custodians go, and I guess other participants, you're talking to pretty big players here. So you can't just you want to remain regulatory compliant in terms of not being a derivative, not being security, and that's all great. But what about the actual participants themselves? How do you ensure compliance and KYC and things like that for them?
You mean on the platform? So if they...
Right, just based on your background and that sort of thing.
Oh, yeah. If I understand correctly, what we do is the CLI origination, so the technology part, that's fully KYB and KYC, right? So that's one thing. Because that needs to be regulated, right? We need to know who is going to be the seller and who is creating this. But most of the KYB and KYC and KYB stuff, we can actually capture from the custodian, right? So you already have done thorough...
That's true, actually, yeah.
Yeah, so we can just take the user ID of whoever has an account at Zodia, and we can rely on on their KYC and KYB onboarding. If you are doing self-custodial, right? So we are also doing KYC and KYB, and one thing that we do there is a company that I previously founded. It's called David, and David is an onboarding solution specifically for tokenized markets, where you can leverage government-issued digital IDs, right? So it's kind of topical because in the EU you have the EIDAS 2 regulation coming up in 2026. Every business needs to be able to accept the European Digital ID. Plus, in the US, you see a rise in MDLs, mobile driver license and stuff, right? So we can all use that. So if you have something like that, you can come to SemiLiquid, do a face scan, and you're good to go. And we have the required information.
Cool. Is there room though for participation from people who, maybe if they want to KYC, but not necessarily have to be like an institutional grade investor, right? Maybe if, like, let's say me, if I'm willing to KYC, is there a way for me to get involved in this sort of market?
Yes, if you are, so from the sell side, you need to be an accredited investor. That's one thing, right? And there's just better safe than sorry. That's essentially what we do, right? Because you're not really certain that it's fully needed, but accredited investor, high net worth investor, you understand the risk that are involved, right? That's kind of like the thing. So if you have an account with Zodia, you can definitely come on, right? Even if you're a natural person. From the other side, if you are a buyer, right? For example, retail. If you double click on that, retail is something that we are definitely interested in supporting, but it's easier to have this secured first and having this environment where B2B can happen, and then open it up to retail, right? It's also much better for regulators to be more comfortable with exploring this, right? So yeah.
Are you essentially? Yeah.
It's not necessarily a technical hurdle, more of just a cautiousness.
Right.
Right, cool. So yeah, the liquidity, like you said, it's going to come from market makers and that sort of thing. So how does the actual, decisions in terms of how to price tokens, could you speak to that a little bit?
Yes, so
And then,
if there is no market for it yet, right? If there is no semi-liquid market for, let's say, let's say you have Ondo tokens that become available next year, right? What you will see as the CLI is the name of the token, so Ondo, and then 02 Feb 26, right? So similar to how an option is named. So that's essentially one of the CLIs. So what we believe is that the shorter tail ones, so the 1 year out or earlier, are going to be tradable, meaning you can sell and buy them on an order book quite easily, right? And how is that being facilitated? By market makers, right? And market makers, they need to have appetite for this. You have professional traders that can arbitrage between the public price and the private market price. It can be really interesting. So you can see all of different sophisticated strategies happening, right? So that's why the 1 year outs, and then the 2 and the 3 year outs, if they are going to be there, because you can argue that if you have 2 to 3 years out, you want to sell your 1 year outs first because you can sell them at a lower discount. But if you do want to get out fully, then 2 year and 3 year outs are available, but it will be more of an auction-based system, right? So it will not be continuous liquidity, but you have more people who can bid on your tokens.
yeah,
I think it makes sense to kind of split it up because the discounts might get extremely severe with the longer time horizon.
Right, but we really would like to do it, right? But the main blocker is not the discounts per se, right? Because the discounts would be discovered by the market essentially, right? So maybe if Layer 0 goes up and there is not enough supply for the 1 year out, could mean that the 2 year out discount would be decreasing, right? Because you want to buy but what we hear from all of the market makers, they are for now not interested in doing market making for 2 and 3 year out, only for the 1 year out, because it's much more interesting to do the arbitrage between the public and the private price.
I see.
Yeah.
Okay. Yeah, that makes sense. Yeah, I don't think we had touched on that previously, so it's enlightening to me. Okay, so yeah, in terms of the future though, do you see this? Obviously we like to be optimistic, but where do you see this, let's say 5 years down the road, like in 2030, how does the unvested token market look?
I think that if we do succeed, what I would like to see ideally is that we will stop going to the centralized exchanges too soon, right? So what we see now is that people and investors, they are pushing the founders that, okay, launch your token, go to the exchange, because they need liquidity, right? They need to get something for their LPs. What happens is that the retail is being that exit liquidity, right? And that's not how it should be, right? So what we believe in 5 years would need to happen is that they stay longer till they have enough monthly active users, till a company and a startup has enough revenue, and then only go to an exchange, making it kind of like similar to how the IPO market works now, right? In traditional capital markets. So that's what we hope to facilitate. And in between, if you need to raise capital, if you need to raise private, you can raise it from sophisticated investors on SemiLiquid. Yeah.
Yeah.
Cool.
Maybe the last one, this is a little more speculative and kind of hyping, but do you think it could become kind of the NASDAQ of locked token claims?
Yes.
That was I'll let you get into the light.
Short answer. Sorry, everyone. Just yes.
Sorry, I'm not good at some of
of
these
course.
other questions. I'm more
Robert, thank you so much for assisting with this. Like you understand it way better than I do. This was a special episode hosted by Robert.
Yeah.
But no, I actually have a lightning round that I do with all my guests.
Yeah.
So I have 9 questions prepared for you, sir. Are you ready to go?
Yeah.
First one, and I ask this often, what would be one Web3 myth that you would like to bust?
That's we're starting out with a difficult one. I think that to stay on topic, right? That the tokens need to be locked away, right? That there is no way of accessing the liquidity without impacting the public market prices, right? Because that's kind of like something that people think and foundations think that, okay, we don't want the private market price because it will negatively affect the public price. And yeah, we want to challenge that assumption.
That was one of the things.
All business, mister. Best part about working with unvested tokens?
Yeah, but
The huge amount of inefficiency, and and why? Because then there is enough money to be made to be spread around all the stakeholders, so we can get everyone moving quite quickly.
Okay. I see that. Okay, hardest challenge when it comes to explaining SemiLiquid to people?
I wish that here we had.
I think liquefaction was kind of like one of the most difficult parts, also for me to understand and to wrap my head around. Because if I'm talking with, for example, with my CTO, he explains things in a more technical level, right? So I really need to understand that. So yeah, I think liquefaction is difficult to explain, but we are starting to make it easier, I think.
Okay. If you were to describe the future of token vesting into one word.
Into one word.
That's all I get.
SemiLiquid.
See, easy one. And if you could redesign one thing about token vesting today, what would it be?
That's okay. I actually just was it.
I think also something. Yeah, I think if you really want to dive into that, maybe you can have longer vesting, right? So you can have 8 years vesting, but give private market access or semi-liquid access in year 2 or something, right? So that's essentially how I would structure vesting.
That's okay.
So I don't know how many people you got around talking to about SemiLiquid, but what's the craziest idea craziest use case that someone pitched you for SemiLiquid?
There is part
Crazy. I don't know if it's crazy, but I think people are also really interested in creating options on top of this, right? And then not cash settled, but token settled, right? So you're saying that layer 0 will be this price at this moment at the unlock date. If you're right, you get the layer 0 tokens. If you don't, someone else gets that, right? So essentially something like that. Plus, we were talking about indexing, right? So indexing the CLI market. So you have the top 10 CLIs, and you can buy that index token essentially on a centralized exchange. So you can get access to the private market of crypto without actually needing to be a client of SemiLiquid. Yeah.
Yeah, sweet.
Okay, nice. What is one other Web3 project that you admire besides your own?
Hyperliquid. And why? Because I think that the distribution strategy and the airdrop has been phenomenal, and we really admire their the off-chain order matching that they have created, and the on-chain settlement, because that's something that we also want to create, but we haven't figured out exactly how they done it. Yeah.
Okay. Yeah, I know everyone is a fan of Hyperliquid anyway, so I'll take that. But tell me, if you were to explain your project to somebody's or your own grandmother, how would you do it?
I thought about this one, and I think it is really difficult. But how you can explain it is that you have some gold at your bank, for example, and when you deposit it, you get a note that says, okay, you can come back and get 1 ounce of gold for this particular receipt, right? So the receipt is the CLI, the gold is the locked tokens, right? And you have agreed to come back in 1 week or 2 weeks, and then you can give the receipt back and can collect your gold, right? So that's essentially what you could say. And the reason why you're locking your gold essentially is because you want to keep it safe, right? But if you're selling it to someone, you don't want to sell the gold, you're selling that receipt to the gold. Yeah.
Okay. Yeah, I think that makes sense, and it's a really easy explanation. Okay, last question of the lightning round. What do you think is the most underrated concept in Web3 at the moment?
Difficult. Underrated concept, I don't know, but I do feel like that there should be more focus on university-led research, right? Because something which has such an impact of what Cornell Tech have been developing, and that we have now took and creating a whole new primitive and a whole net new marketplace for. I think that's something better to focus your time and energy on than seeing what the next AI agent will be, right? So that.
Well, I'm not the AI guy, so I kind of agree with them. I'll ask Marco later.
Let's hope Marco doesn't stumble in the room. Yeah, that's it for the lightning round. But yeah, I do agree when it comes to education. That's why I have. When it comes to Oasis, because I'm doing both the podcast and Oasis, but we do have a university program, and I do believe that most of the, if not exactly all of the good ideas came from the halls of universities and research students. So I think that's a very important thing to care about. But yeah, guys, thank you so much for joining me.
Happy to go.
Robert, thank you for assisting. Rico, it's been a pleasure having you. I think everybody will be keeping an eye out on your project. Do you guys have socials that somebody could follow at the moment, or you're not there yet?
No, we're not there yet, but maybe when this comes out, we have.
Okay. If you have any, I don't know when this episode will be shared, probably in about 2-3 weeks. But whenever it comes out and you have socials, I'll make sure to include them in the video descriptions and podcast descriptions, everything. But yeah, again, thank you so much for joining. I wish you great success with your project. I have no doubt that it will be one of the cool use cases and projects in Web3.
Question from the crowd.
Sure.
What does the soft launch look like? What does it look like for an accredited investor?
What was the second one?
What does it look like for an accredited investor?
Yeah, so
Repeat it to the podcast.
yeah, of course. So the soft launch is kind of like a launch with 4 custodians, right? So 4 custodian integrations, and we need to curate a list of, let's say, 15 tokens that are in appetite for market makers to use and the VCs. And then I think for an accredited investor, what you're saying, right, is it's similar to if you have a custodian account, right? So if you have Zodia as your custodial account, then you can participate in that pilot, right? Yeah, I think.
Resume. What?
I forgot to mention that we have a live audience today, and thank you for the question. But yeah, that's about it. I'll see you for the next episode. In the meantime, keep an eye out on Rico and SemiLiquid. Follow the Privacy Now podcast on Spotify, YouTube, Apple Podcast. Share it with your friends if you like the episode. It would mean a great deal for me. Until then, stay safe, stay private.
It's fake. Yeah.
And stay semi-liquid.
Stay semi-liquid.
It's like.